Today, higher still, the Property Imperative Weekly to the 21st of December 2019. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. In this edition of our weekly digest, US markets climb even higher on the back of more positive news, Brexit hardens as the new Bank of England Primo is announced, and the World Bank warns of waves of debt. While locally, wages growth will remain weaker for longer as households hunker down, the government seeks to achieve its budget surplus goal, and we swelter from a heat wave, the likes of which we've not seen before. The S&P 500 hit a record high for a seventh straight session on Friday, driven by continued optimism on resolving the US-China trade war, and strength in domestic consumer spending lifted sentiment. The Dow Jones Industrial Average rose 0.28% to 28,454. The S&P 500 gained 0.51% to 3,221, and the Nasdaq Composite added 0.42% to 8,924. The US economy is on the verge of completing a calendar decade without recession for the first time in history. In July 2019, the economy officially entered the longest stretch of economic expansion, at least since 1854. Consumer spending, a key to US economic growth and a major focus for investors, rose 0.4% in November, adding to a string of upbeat data that have helped put behind recession fears which dogged markets earlier this year. Personal incomes grew more than expected, and the personal consumption component of the Q3 GDP was revised higher, along with the University of Michigan Consumer Sentiment Index for the month of December. Despite lingering trade conflict, the US GDP growth rate did not fall below 2% in the first three quarters of 2019, buoyed by strong consumer spending, which constitutes more than 70% of the economy. Additionally, a solid labour market and gradual wage growth offset the drop in business spending and manufacturing activities. The US manufacturing output jumped 1.1% in November. And more important information was that the core durable goods order, which excludes defence aircraft, jumped 1.2% in October, indicating perhaps a bottoming out of the weakness in business spending. The National Association of Home Builders Monthly Confidence Index increased 5 points to 76 in December, from an upwardly revised 71 in November, and December's figure represents the highest index reading since June 1999. The IHS Markit Flash US Composite PMI Output Index grew to 52.2 in December from 52 in November, and any reading above 50 reflects improvement in economic activities. Though US Steel Corp fell 11.1%, as it said it will need to shut down most of its facility near Detroit and lay off 1,545 workers and slash its dividend. The company has been facing slowing demand even as it enjoyed the protection of Trump's trade war. On December the 13th, both the United States and China declared that they have reached a Phase 1 trade deal likely to be signed by the two presidents in the first half of January. US Trade Representative Robert Lighthizer said the deal will address intellectual property disputes, along with strong enforcement provisions and financial services and currency issues, in addition to tariff rollback and higher agricultural purchase. And President Donald Trump claimed progress on issues from trade to North Korea and Hong Kong after speaking with Chinese President Xi Jinping, dispelling fears of another escalation in the trade dispute. The US House of Representatives recently approved the USMCA trade deal, which will replace the previous NAFTA deal between the United States, Mexico and Canada. And on December the 12th, the Fed Chair Jerome Powell reiterated that the central bank is set to maintain a stable monetary policy in 2020 and will contemplate raising rates if inflation surges systematically. No surprise then that gold was down 0.17% to $1,481.95, while the 10-year bond rates were up 0.57% to 1.919, while the 3-month was up 0.17% to 1.577. That inverted yield curve seems an age away. Bitcoin was up 0.48% to 7,225 as Fed member Lael Brainard, citing an academic study, said Bitcoin still contains a significant malicious user base. Only a third of the most popular exchanges require ID validation and proof of address to make a deposit or withdrawal. This is troubling, she said, since a number of studies conclude that cryptocurrencies support a significant amount of illicit activity. As much as 50% of all Bitcoin transactions were in some way conducted against the law. One study estimated that more than a quarter of Bitcoin users and roughly half of Bitcoin transactions, for example, are associated with illegal activity. To which my question is, how would they know that? The House of Representatives approved the new North American trade deal, and it now goes to the Senate. It's not clear when the deal will be discussed, since the Senate has to contend with the impeachment process first. The new USMCA trade pact, which was first agreed on in September last year, is due to replace the original NAFTA set up in 1994. The New Deal reportedly has tougher labour and automotive content rules, but leaves $1.2 trillion in annual US-Mexico-Canada trade flows, largely unchanged. Elsewhere, Japan reported a November CPI up 0.5% year over year, and that's up from 0.2% in October. And it finished last year at 0.3% and 2017 at 1.0%. The measure the Bank of Japan targets excludes fresh food. By this metric, core inflation rose to 0.5% from 0.4%, and it stood at 0.7% at the end of the last year and 0.9% back in 2017. Excluding fresh food and oil, Japan's CPI rose to 0.8%, the highest in 3 years, and Japan's sales tax increase from October the 1st and the free preschool initiatives have distorted the data. And when adjusted for core inflation, it's actually closer to 0.2%. And the Bank of Japan cannot be content with that result, but frankly, it's out of runway now. In China, the People's Bank of China left its one-year loan prime rate unchanged at 4.15%, which surprised the market. Many economists expect further easings next year to support the economy, which is expected to hover around 6% growth next year. Two developments in the UK dominate the European session. First, the head of the Bank of England's Financial Conduct Authority, Andrew Bailey, has been picked to succeed Mark Carney at the end of next month as the Governor of the Bank of England. Recently, former Deputy Governor Shafiq had been seen as the front-runner, though Bailey was always seen as a safe choice, and he will serve an 8-year term. Some reports suggested Shafiq was more critical of Brexit. And Bailey may be an old hand at the Bank of England, but he has not served on the Monetary Policy Committee, and his views are not clear. And note that Carney has agreed to extend his term for a third time from the end of January to mid-March to allow for a smooth transition. Second quarter UK GDP was revised to 0.4% from 0.3% on the back of stronger services, and private consumption was shaved to 0.3% from 0.4%, while government spending fell by 0.6% instead of increasing by 0.3%. The net export function improved as net export growth was revised to 7.9% from 5.2% and a 4.1% contraction in quarter two. Imports fell by 0.3% rather than a rise by 0.8%, as was previously estimated, and the result, there was a sharp improvement in the third quarter current account deficit from a shortfall of £24.2 billion in quarter two to £15.9 billion in quarter three, which is the smallest deficit in 7 years. And Sweden's central bank ended half a decade of negative interest rates, bringing relief to its finance industry and proving a test case for counterparts around the world experimenting with sub-zero borrowing costs. The Riksbank's governor Stefan Ingves downplayed the growth outlook. in the lead up to the decision, with a focus on the harmful effects of negative policy, in particular the danger that ultra-low borrowing costs might stoke risky investing. He also insisted that the measure is designed to be temporary. The Swedish increase on Thursday marked a turning point in the history of a policy pioneered in recent years by three other European economies, as well as the Bank of Japan. The Riksbank had flagged the shift so well in advance that no one was surprised. Inflation has been close to the Riksbank's target of 2% since the start of 2017, and the Riksbank assesses that conditions are good for inflation to remain close to the target going forward, the bank said on Thursday. And it also said that the repo rate is expected to remain at zero in the coming years, and kept a goal of purchasing bonds through so-called quantitative easing until at least the end of 2020. So while policymakers have increased their so-called repo rate to zero, the Riksbank's deposit rate remains in negative territory, though that facility isn't the pivotal benchmark to borrowing costs in Sweden's economy. The European Central Bank, the Swiss National Bank, Denmark's Central Bank, and the Bank of Japan are the remaining institutions currently sticking with sub-zero policy as a central plank of their monetary stance. And ECB officials, whose own rate is now at minus 0.5% after a cut in September, increasingly emphasise the harmful impact of negative rates, from the squeeze on lenders' profit margins to the threat posed to financial stability by incentivising investments in riskier assets. After the Riksbank's hike, only 4 central banks have negative interest rates, as this Bloomberg chart shows. And finally, the World Bank has warned the largest and fastest rise in global debt in half a century could lead to another financial crisis as the world economy slows. The Global Waves of Debt report looked at the 4 major episodes of debt increases that have occurred in more than 100 countries since 1970, the Latin American debt crisis of the 1980s, the Asian financial crisis of the late 1990s, and the global financial crisis from 2007 to 2009. And the bank said that during the fourth wave from 2010 to 2018, the debt to GDP ratio of developing countries has risen by more than half to 168%. The size, speed and breadth of the latest debt wave should concern us all, they concluded. Sound of stable door closing after the horse has bolted once again. Now I'm going to make a longer post on this particular topic later. Hi, it's Liz's interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. And so to the Australian news, where MYEFO this week painted a picture of weaker wages growth and an economy being supported by a stronger than expected iron ore price. For every $10 higher, an additional $3.7 billion goes to the coffers. And yes, the government's surplus is still being promised. See our post, reality hits the budget? Well, sort of. They do, however, forecast lower commodity prices in the outer years. Yet, magically, things are still looking okay in their numbers. This is frankly a work of poor fiction, I fear. The surpluses are very small, roughly half the size of those promised at the time of the April budget, and they are highly uncertain. The underlying cash surplus of $5 billion forecast for 2019-20 is indeed small, a fraction under 1% of the total receipts number of $502.5 billion. And according to the MYEFO chart, the confidence forecasts are also considerably uncertain. And this government is expected to do something no government has done since the late 1980s, cut spending in real per-person terms over 4 consecutive years. Budget surpluses and low interest rates reduce debt repayments, and low inflation and wage growth will reduce the cost of payments such as the pension and New Start. But the government is also expecting to keep growth low in other areas of spending, in almost every area other than defence and the expanding National Disability Insurance Scheme. Such assumptions and long-term spending squeezes on things such as New Start and aged care are hurting vulnerable Australians. And frankly, I think we are better than this. That said, unemployment was slightly lower this time around, down to 5.2%, though with more part-time roles. But more concerning was the ABS data on migration and age distribution, which we discussed in our post The Demographic Time Bomb, Migration and Big Australia. This is an important long-term issue for us. High net migration is supporting the economy even as it continues to put pressure on wages and on infrastructure. As one of my viewers posted this week, water will become the next big focus as demand outstrips supply across the continent. And the ABS released their new data series this week on loan flows. This includes some enhancements on the old data, though mostly back only to July 2019, as well as some of the previously reported series. It will take some time to examine these in more detail, but here are my initial thoughts. New loan flows rose through the past few months, though the rate of growth slowed in October. There was a stronger focus on owner-occupied loans than investor loans, as expected, and first-time buyers also remain active, mainly for owner-occupation purchase. And the RBA released their latest household ratios based on ABS series data, a week earlier actually than normal. Interestingly, the numbers have been recast. The debt-to-income ratio had been up to 191 in June, whereas the June number is now down to 188.3 and the September measure down to 186.5. The fall is probably explained by lower lending and the income uplift thanks to the tax cuts, as the ratios are based on disposable income. That said, owner-occupied lending ratios now standing at 97.4. The household assets to income ratio rose thanks to rises in the value of stocks and shares and an uplift in home prices. And housing assets to income now sits at 494.6, down from the highs of 2017. And the ratio of interest payments to income also improved thanks to lower interest rates this year and an uplift in disposable income thanks to the tax cuts and refunds. Housing interest payments to income is 6.5. The CoreLogic price index continues to track higher, with rises of 0.61% in Sydney last week and 0.32% in Melbourne. These gave the quarterly moves a shove higher, other than Perth, which fell 0.31%. Though other than Brisbane, all the indices are still below their previous peaks. So it'll be interesting to see what 2020 brings, because both MYEFO and the RBA statement this week stressed that home price growth was a critical driver of making households spend more. This despite the record debt that we hold. And by the way, REA's Nera Crosby was interviewed by Peter Switzer, and she discussed the fact that there is still a divergence between their index, which has been audited by Deloitte, and that provided by CoreLogic. So, frankly, we're still in a bit of a quandary as to which index is right. And while Nerida said that home prices were moving higher, she didn't give any specific figures. And in fact, the last that we've got from REA is that Sydney prices were up 0.8% over the last 3 months, which is so much lower than CoreLogic as to be amazing. And finally, Westpac and NAB got hit by more bad news this week, with both APRA and ASIC pressing on various cases derived from the AUSTRAC and Royal Commission related issues. And as a result, the banks had a bad week, with ANZ down 0.36% on Friday to 24.80, CBA down 0.59% to 81.25, NAB down 0.52% to 24.89, and Westpac down 0.57% to 24.25. The regionals were also weaker, while Macquarie Group rose 0.17% to 140.25. The Aussie was stronger on the back of the lower unemployment data and more directly because of changes in the US dollar. It was up to 69.01 on Friday, and that was up 0.24% on the day. The euro Aussie dollar was down 0.57% to 1.6050, and the gold Aussie cross was down 0.26% to 2,142, while the Aussie Bitcoin cross was up 0.04% to 10,473. And so, as we come to the end of the year, the US markets are looking quite strong, and fears of a recession are easing for now. But in Australia, there are more serious economic and environmental cracks appearing as the country burns and as the economic data continues to wobble. The best growth hope appears to be higher home prices, leading to household spending again, but then the data suggests this may not be enough, especially if commodity prices weaken faster. I continue to think 2020 will be an interesting year. Anyway, stay safe over the holidays, enjoy the break if you can, and my thoughts are with those battling the bushfires and the hundreds of people displaced. DFA will continue to release some shows over the next couple of weeks. We've got a few interviews in the can already and more data to discuss. And finally, thanks for your support over the year. We could not have done this without you. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.